Oh, sorry. Okay. Okay. In this chapter, we will discuss the role of budgeting in planning, control, and decision making. First, plan. Second one is prepare the operating budget, identify its major components, and explain the international interrelationship of its various components. And third one, prepare the financial budget, identify its major components, and explain the interrelationships of its various components. And then prepare flexible budgets for planning and for performance reporting, describe the behavioral dimension of budgeting. Or let's go. To check. Okay. Let's talk about something. Budgets can be found in one's everyday life. Every time before you visit the grocery store, do you decide which items you need and how much you need? For few items, do you even decide whether you should keep in surplus on hand for emergency? Do you also keep a mental note of items that are there at home? If your answers for these questions yes, then you are implicitly making a purchases budget for groceries. Now think of other budgets that you prepare. Okay. Description of budgeting. Budget is should prepares Uh, all businesses should prepare budgets. Budgets help business owners and managers to plan ahead, exercise control by comparing what actually happened to what was expected in the budget. Budgets formalize managers' expectations regarding sales prices and costs. Even small businesses and nonprofit entities can benefit from the planning and control provided by budgets. Budgeting and planning of control. Planning and control is linked. Planning is looked ahead to see what actions should be taken to realize particular goals. Control is looking backward, determining what actually happened and comparing it with the previously planned outcomes. Budgets, it will be financial plans for the future and are a key component of the planning. Identify objectives and then the actions needed to
Kemarin cuma
achieve
update
them.
aja yang bulan lalu dicek kan harus bukunya masih muncul. Kemarin itu hari itu tidak dapat telepon saya harus dicek lagi listriknya. Udah hilang apa belum bukunya. Saya mau proses tunggu itu.
Before preparing a budget, an organization should develop a strategic plan. Strategic plan plots a direction for an organization's future activities and operations. Generally, budgeting covers at least 5 years. This is figure out budgeting, planning, and control. Planning cycle and then control cycle. We would learn planning cycle is consists of 5 systems. Strategic plan, first of all, long-term objectives, short-term objectives, short-term plan, and then overall budgets. Budgets will go with feedback to execution to control cycle. control cycle, monitoring of actual activity, comparison of actual with planet, and then investigation. And then also we'll go to corrective action. Advantages of budgeting. A budgetary system gives an organization several advantages. First of planning, second one, information for decision making, and third one, standards for performance evaluation, improved communication and coordination. The master budget, comprehensive financial plan for the organization as a whole type of budgeting. This is called the master budget. Master budget typically for a 1 year period corresponding to the fiscal year of the company. During a year, it will be provided. Yearly budgets are broken down into quarterly, this make in 4 quarters, and then monthly in 12 size budgets. Use of smaller time periods allows managers to compare actual data with budget data more frequently. Problems may be noticed and resolved sooner as soon as possible. Some organizations have developed a continuous budgeting philosophy. Continuous budget is a moving 12 months budget. As a month expires in the budget, an additional month in the future is added so that the company always has a 12 months plan on hand. Proponents and of continuous budgeting maintains that it forces managers to plan ahead constantly. Master budgeting, directing and coordinating. Most organizations propose a master budget for the coming year during the last 4 or 5 months of the current year. And maybe for 2026 master budget, it was prepared from September of 2025, at least. A budget committee must learn this type of subject. Reviews the budget, provides policy guidelines and budgetary goals, resolves differences that arise as the budget is prepared, approves the final budget, monitors the actual performance of the organization as the year unfolds. Controller usually serves as the budget director, person responsible for directing and coordinating the organization's overall budgeting process. Master budget, we will learn major components. A master budget can be divided into operating and then financial budgets. What are they? Let's identify this terms of operating budgets. Describes the income generating activities of a firm. Sales, production, finished goods, inventories, and etc. Outcome is a pro forma or budgeted income statement. Financial budget. Financial budget is details the inflows or outflows. Exactly. Cash inflows, outflows appear in the cash budget. Expected financial position at the end of the budget period is shown in a budgeted or pro forma balance sheet. Since many of the financing activities are not known until the operating budgets are known, the operating budget is prepared first. That's why financial budgets, it will come secondly. Okay, the master budget and its interrelationships. First, there is a figure out determined for us. Master budgets, interrelationships. First of all, sales budgets, production budget, direct materials, direct labor, overhead budget, and selling and administrative expenses budget. There is a Next one is ending finished goods inventory budget. It's divided into unit cost and then cost of goods sold budget income. And then that we go from production budget to cash budget. From cash budget, we budgeted balance sheet, budgeted statement of cash flow. And then overall, we need to capital budgeting. It's knowledge check activity. Which of the following statements is true about financial budgets? This budget describes the income generating activities of a firm, such as sales budget. Second answer, the ultimate outcome of the financial budget is a pro forma or budgeted income statement. C variant, this budget details the inflows and outflows of cash and includes its cash budget. And then these budgets are prepared before operating budgets. Which of the following statements is true about financial budget? The correct answer is C. This budget details the inflows and outflows of cash and includes cash budget. Financial budgets details the inflows and outflows of cash and overall financial position. Planned cash inflows and outflows appear in the cash budget. The expected financial position at the end of the budget period is shown in a budgeted pro forma balance sheet. Preparing the operating budget. Operating budget consists of a budgeted income statement accompanied by the following supporting schedules. First of all, sales budgeting. Second one, production budget. Third one, direct material purchases budget. And then direct labor budget, overhead budget, selling administrative expenses budget, ending finished goods inventory budget, cost of goods sold budget. What is sales budget? Every term, well, here we show 1, 2, 3, 4, 5, 8 terms, we don't add. 8 terms we will open, identify the main purposes of these budgets. Sales budget. Sales budget consists of approved by the budget committee and then describes expected sales in units and in dollars, maybe in other currency. Basis for all of the other operating budgets and most of the financial budgets. Important that it be as accurate as possible, because the first step in creating a sales budget is also to develop the sales forecast. Sales forecast is just the initial estimate and it is often adjusted by the budget committee. Production budget. Production budget tells how many units must be produced to meet sales needs and to satisfy ending inventory requirements. To compute the units to be produced, both unit sales and units of beginning and ending finished goods inventory are needed. Units to be produced, how we determine this indicator. This indicator will be expected unit sales plus units in desired ending inventory minus units in beginning inventory. Direct material purchases budget. After the production budget is completed, The budgets for direct materials, direct labor, and overhead can be prepared. Direct material purchases budget loans tells the amount and cost of raw materials to be purchased in each time period. Depends on the expected use of materials in production and the raw materials inventory needs of the firm. Company needs to prepare a separate direct materials purchases budget for every type of raw material. Direct material purchases budget we will determine by this formula. Purchases equal direct materials needed for production plus direct materials in desired ending inventory minus direct materials in beginning inventory. Direct labor budget. Direct labor budget shows the total direct labor hours and then direct labor cost needed for the number of units in the production budget. Budgeted hours of direct labor are determined by the relationship between labor and output. Overhead expenses budget. Overhead expenses budget shows the expected cost of all production costs other than direct materials and direct labor, except maybe. Many companies use direct labor hours as the driver for overhead. Costs that vary with direct labor hours are put and called variable overhead. Remaining overhead items are pulled into fixed overhead. Ending finished goods inventory budget. Ending finishing goods inventory budget supplies information needed for the balance sheet. Balance sheet visual serves as an important input for the preparation of the cost of goods sold budget. To prepare this budget, unit cost of producing finished goods must be calculated by using information from direct materials, direct labor, and overhead expenses budgets. Cost of goods sold budget reveals the expected cost of the goods to be sold. Selling and administrative expenses budget outlines planned expenditures for non-manufacturing activities. Maybe it is salary of the director, maybe salary of manager. It will consist of selling and administrative expenses can be broken down into fixed and variable components. Items as sales commissions, freight, and supplies vary with sales activity. Budgeted income statement. Budgeted income statement is a compilation of budgeted cost of goods sold schedule and then budget, selling administrative expenses budget. Company has all the operating budgets needed to prepare an estimate of operating income. Operating income is not equivalent to the net income of a firm. Sometimes we describe that operating income is equal to the net income. No, it is not really right. To yield net income, interest expenses and taxes must be subtracted from operating income. Knowledge check activity. Second, which of the following is not part of the operating budget? Not. There is 5 answers. First one, the direct labor budget, the cost of goods sold budget, the production budget, the capital budget, the selling and administrative expenses budget. There is answers D, the capital budget. The capital budget is not consist of, not part of operating budget. Operating budget consists of, there are 8 terms identified. We budget income statement, it combines the supporting schedules, sales, production, direct purchases, direct labor, overhead budget, selling, administrative expenses, ending finished goods inventory budget, cost of goods sold budget, but not the capital budget. Capital budget is the main activities. Preparing the financial budget. After making operating budget, we will learn preparing the financial budget. Financial budget, remaining budgets found in the master budget as a financial budget. Usual financial budget prepare for cash budget, budgeted balance sheet, budget for capital expenditures. Cash budget. First, cash budget. To learn about cash budget, understanding cash flows is critical in managing a business. Often a business successfully produces, sorry, often a business successfully produces and sells products but fails because of timing problems associated with cash inflows and outflows. Because cash flow is the lifeblood of an organization, the cash budget is one of the most important budgets in the master budget. There is a cash receipt for understanding cash budget. Basic structure of a cash budget is includes cash receipt, disbursements, and excess of deficiency of cash and financing, as shown below. First one, mm, expected beginning balance sheet. Expected beginning balance sheet 3,000. Uh, Add cash receipt 48,000, 45,000, and then also equal if we plus together 48,000 cash available. We need less disbursements minus it will be cash budget. We learn it about expected ending balance. We need 9,000. Cash budget in this cash available consists of the beginning cash balance and the expected cash receipts. Expected cash receipts include all sources for cash for the period being considered. The principal source of cash is from sales, since large proportion of sales is usually on account. A major task of an organization is to determine the pattern of collection for its accounts receivable. Guys, if anyone appears a question, you can type in on this chat. I will answer to this chat, by the way. If a company has been in business for a while, it can use past experience to determine what percentage of credit sales are paid in the months following sales. This is used to create a schedule of cash collections on accounts receivable. Cash disbursements. Cash disbursement section lists all planned cash outlays for the period. All expenses that don't require a cash outlay are excluded from the list. Example, depreciation. Just as source of cash may require a schedule of cash collections on accounts receivable to calculate cash expected from credit sales, the disbursements section may require KA in handling payments on account. Cash excess of or deficiency. Some companies expand the basic cash budget format by adding lines to show any borrowing or repayment necessary to achieve a minimum desired cash amount. When this is done, the preliminary ending cash balance is called cash excess or deficiency. Cash excess or deficiency line is compared to the minimum cash balance or lowest amount of cash acceptable as noted by company policy. If a cash deficiency exists with less cash on hand than is needed, the company usually obtains a short-term loan. A cash excess is usually used to repay loans or used to make temporary investments. Cash budget, borrowings and repayments. If a company converts its preliminary cash balance line to a cash excess deficiency line, it may be borrowing or repaying money. If there is a deficiency, this section shows the necessary amount to be borrowed. When excess cash is available, this section shows planned repayments, including interest expenses. Ending cash balance. Last line of the cash budget is the ending cash balance, planned amount of cash to be on hand at the end of the period after all receipts and disbursement, as well as borrowings and repayments are considered. Budgeted balance sheet. Budgeted balance sheet depends on information contained in the current balance sheet and in the other budgets in the master budget. Explanations for the budgeted figures are typically provided in the footnotes. There is discussion activity. Why would the company want a minimum cash balance? Suppose that the minimum cash balance is 1000K. And then that the projected cash surplus is 500. What would the company have to do to achieve the desired minimum? The answer, a minimum cash balance is needed to reduce the risk of insufficient funds and satisfy account agreements with the banks. In the event of a shortage, it is necessary to borrow the difference. This is the correct answer. Using flexible budgets for planning performance reporting, budgets are useful for both planning and control, where they are used as benchmarks for performance evaluation. Flexible budget serves both planning and control needs. Flexible budget. Flexible budget enables a firm to compute expected costs for a range of activity levels. Flexible budget, also known as a variable budget. Flexible budget, key to flexible budget is knowledge of fixed and variable cost. If we determine about fixed and variable cost, it will be clear to understanding flexible budget. Two types of flexible budgets are before the fact and then after the fact. First, before the fact, budget that gives expected outcomes for a range of activity levels provides useful information for planning and decision making before the act. After the act, budget that is based on the action level of activity. That is comparing actual cost to the static budget. That is first, mm, before the fact and then after the fact. Before the fact, we do budgeted. After the fact is actual. Units produced, we planning 1060 units, and actual we produced 1200. Uh, Between them, the main difference is 140 units. Direct material costs. Direct material cost is also dependent if we are, it is variable cost. If we produce it more units, then direct material cost also increased. That's why we planned for 1060 units, 4240, but actually we produced 1200. It means 4830. Direct labor cost. Direct labor cost, also variable cost. Variable cost, there is, we planned 1272. Actually, we have 1.500. Okay, variable overhead costs, there is no maintenance. It's we planned 477 and then actual 535. Okay. Okay. Then power, like a depreciation, fixed overhead. Power, I'm sorry, power is, we planned 159. We had 170. Action. Fixed overhead. Fixed overhead, we have groundskeeping. Groundskeeping, we need budget. We planned 1200 and we had 1050. Depreciation. There is all we have 600 actually we need. And then all of them, if we adding each other, we need actual price, actual budget. We have 8,685. We planned 7,948. There is difference between them, 737. Okay. Here is example. Activity number 1 and number 2, I'm sorry. The flexible budget for 3,500 units shows a unit cost of $4.60. The unit cost for 5,500 units is $4.20. Why is the unit cost less for more units? Is your answers? Okay, there is an answer. Why we, if we more produce it, more units produced, our cost will decrease. Why? The unit cost is less for greater number of units because there must be fixed cost involved. As production goes up, the unit cost goes down as there are more units for over which to spread the same total fixed cost. It depends on only fixed cost, not variable cost. Budgets often used to judge the performance of managers. Bonuses, salary increases, and promotions are all affected by a manager's ability to achieve or beat budget goals. Since a manager's financial status and then career can be affected, budgets can have a significant behavioral effect. Whether that effect is positive or negative depends in large part on how budgets are used. Alignment of managerial organizational goals is often referred to as a goal congruence. If the budget is improperly administrated, subordinate managers may subvert the organization's goal. Dysfunctional behavior is individual behavior that conflicts with the goals of the organization. Sometimes we come across this uh, alignments. Okay, about positive behavior. Positive behavior include these key features. First of them is frequent feedback on performance, monetary and non-monetary incentives, participative budgeting, realistic standards, controllability of costs, multiple measures of performance. It is a reasonable degree of a positive behavior. Frequent feedback on performance. Managers need to know how they are doing as they progress. Frequent timely performance reports allow managers to know how successful their efforts have been, to take corrective actions, and to change plans as necessary. Monetary and non-monetary incentives. Incentives are the means an organization used to influence a manager to work to achieve its goals. Traditional organization theory assumes that employees are primarily motivated by monetary rewards. They resist work and they are inefficient and wasteful. Monetary incentives are used to control a manager's tendency to shift and waste resources by relating budgetary performance to salary increases, bonuses, and promotions, overall KPIs. Non-monetary incentives, including job enrichment, increased responsibility and autonomy, and recognition programs can be used to enhance a budgetary control system. Rather than imposing budgets on subordinate managers, participative budgeting allows subordinate managers considerable say in how the budgets are established. Increased responsibility and challenge inherent in the process are non-monetary incentives that lead to a higher level of performance. Participative budgeting has three potential problems. First, setting standards that are either too high or too low. Building slack into the budget, often referred to as a padding in the budget. And then pseudo participation. Pseudo participation, it means you have not really participate on the budget, but on papers you have pseudo participation. Standard settings, some managers may tend to set the budget either too low or too tight. Since budget goals become the manager's goals when participation is allowed, making this mistake in setting the budget can result in decreased performance levels. Trick is to get managers to set high but achievable goals. Budgetary slack or padding the budget. Budgetary slack is second problem with participate budgeting is the opportunity to build slack into the budget. Budgetary slack exists when a manager deliberately underestimates revenues or overestimates costs in an effort to make the future period appear less attractive in the budget than they think it will really be. This approach increases the likelihood that the manager will achieve the budget and consequently reduce the risk that the manager faces. Act of Paddington. Act of padding the budget is questionable when considering what is viewed as an ethical professional practice. It is not communicating information fairly and objectively and constitutes a violation of the creditability standard. Pseudo-participation. Pseudo-participation is a main problem. Top management is simply obtaining formal acceptance of the budget from subordinate managers, but not seeking real input. Since budgeting objectives are used to gauge performance, they should reflect operating realities, including the reality standards. First of all, actual levels of activity, flexible budgets are used to ensure that budget costs can be realistically compared with costs for actual levels of activity. And then seasonal variation, interim budgets should reflect seasonal effects. Example, maybe toys are used would expect much higher sales in the quarters that includes Christmas than in other quarters. Efficiencies of realistic standards. Budgetary cuts should be based on planned increases in efficiency and not simply arbitrary across the board reductions. Across the board cuts without any formal evaluation may impair the ability of some units to carry out their missions. General economic trends, general economic conditions also need to be considered. Budgeting for significant increases in sales when a recession is projected is not only foolish but also potentially dangerous. Controllability of costs. Ideally, managers are held accountable only for costs that they can control. Controllable costs are costs whose level a manager can influence. If non-controllable costs are put in the budget or subordinate managers to help them understand that these costs also need to be covered, then they should be separated from controllable costs and labeled as non-controllable. Multiply measures of performance. Some organizations make the mistake of using budgets as their only measure of managerial performance. While financial measures of performance are important, overemphasis can lead to a form of dysfunctional behavior called milking's form of myopia. Myopic behavior occurs when a manager takes actions that improve budgetary performance in the short run but bring long-run harm to firm. Budgetary measures alone cannot prevent myopic behavior. Knowledge check activity number 3. Which of the following is not an advantage of participative budgeting? Answer A. It encourages budget slack. It tends to lead to higher level of performance. It fosters a sense of responsibility. It encourages greater goal congruence. It fosters a sense of creativity in managers. The correct answer is A. It encourages budgetary slack. It is not. Budgetary slack or padding the budget exists when a manager deliberately underestimates revenues or overestimates costs in an effort to make the future period appear less aggressive. Self-assessment. Self-assessment is describes the role of budgeting in planning, control, and decision making. Explain an operating budget and then financial budget. Identify its major components and explains the interrelationships of its various components. Discuss flexible budgets for planning and for performance reporting. Explain behavioral dimension of budgeting. Summary. And then it's the last of our lessons ended. You should learn about discussing the role of budgeting in planning, control, decision making. Uh, you with your teacher or with your curator or with your tutor prepares the operating budget, identifies major components and explains the interrelationships of its various components. Uh, you should propose a financial budget, identify its major components, explain the interrelationships of its various components, prepare flexible budgets for planning and for performance reporting, and describe the behavioral dimensions of budgeting. That's all, students. Now, all lessons. Okay. Oh, there is. Oh, there is question. Sukma, there is Sukma. Excuse me, sir. Thanks for your great explanation. To what extent can intelligence? To what extent can artificial intelligence and big data analytics enhance the rationality and efficiency of capital budgeting decisions And at what point does reliance on algorithmic decision making introduce new financial strategic and governance risk? Okay, let's answer to the question. Okay. uh, uh, Once more. To what extent can artificial intelligence and big data analytics enhance the rationality, efficiency of capital budgeting decision? And at what point does reliance on algorithmic decision making introduce new financial strategy? Okay, nowadays, thank you for a question, Ms. Sukma. Uh, we know that artificial intelligence (AI) uh, as a potential help banks in financial sphere, improves their efficiency, reduces costs, and then enhance customer experience. I can count here is some examples for not only financial, not all over the world, impacting AE and big data analysis. The first of is the integration of big data analytics, artificial intelligence, and blockchain technologies in business and management opens door for present and future opportunities. The potential of these technologies lies in transforming business operations and creating new business models through digitalization. AI and big data can help banks provide personalized and seamless service to customers through chatbots, voice assistants, robo-advisors, or any recommendational systems. Maybe the clearly example is ChatGPT. ChatGPT is this language model that understands and generates human-like responses. It's machine learning, not only banking, all over the world in study services, in financial sector, anywhere we can use ChatGPT and similar models to offer to custom services 24 to 7. First example, then about management risk, about risk management. Risk management is AI and big data can help to financial sector in detecting and preventing fraud positions from money laundering, cyber attacks, and other risks for by analyzing large volumes of data and identifying patterns, uh, anomalies, behaviors. Cybersecurity is an application of AE. Nowadays, it's very, very familiar, famous typing is two types verification by phones, maybe programs, anyway. Uh, For example, in bank system, a artificial intelligence help banks monitor transaction, verify identities, flag suspicious activities, and alert customers for getting loan or not getting loan, or authorities in real time, how much and how is anything else. Efficiency, about efficiency of AE and big data is it is first of all reduces our times, our mistakes, errors, interruptions, enhances overall value of efficiency. It's a very efficient business. About business models, predictive analytics, social banking, behavioral finance like behavioral budget, and open banking are some of the creative and uh, novel services that banks offer, made possible by the tools of big data and AE. In the era of digitalization, these services improve uh, the quality of financial sector and help create a new revenue streams. For instance, maybe for example, artificial intelligence. I'm sorry. In financial sector, detecting data on the customer preference and offers them solutions to their problems with their time frame. Oh, that is a good question. Uh, uh, the, uh, Patients can cause participatory budgeting to have a negative impact on motivation. Um, this is about participatory budgeting. This participatory budgeting is can demotivate when targets are seen as unfair or unattainable, leading to stress and slack when it's too time consuming, and then when disagreements over priorities arise or managers feel their input isn't valued, especially in centralized systems, maybe creating pressure and reducing in-stream motivation. I don't know. And then negative impacts also negative impacts also item for budgetary slack, inflexible budgets, and focus on control rather than autonomous indicators and then motivations. Uh, and okay, about demotivation, uh, demotivations. There is uh, some type of demotivation. I will tell you about it. First one is equity theory. Equity theory, if targets seem irrelevant or unfair compared to others, it breeds resentment. Or time of resource drain. Time of resource drain, the process can be lengthy, take time away from core tasks and frustrating participants. Maybe you want this aim, this road, and you go another roundable to go this round. This time and resource drain. Conflict and disagreement. Conflict and disagreements over spending priorities or budget cuts can create conflict between team and departments. There is budgetary slack, maybe budgetary slacks. Also, managers might deliberately create slack to look good or cope with uncertainty, which can distort performance and breed desserts. Anything else? Oh, there is. Oh, last time question. Okay. Excuse me, Prof. I want to ask about in terms of budgeting, as is there differences in the budget components between small enterprises and then medium-sized enterprises? If so, what components are mandatory for both? Okay, to this question, I will answer yes. Budget components differ between small business and medium-sized business, and then primary informality detail integration with small business, often using informal, cash-focused, intuitive budgeting, revenue, expenses, cash flow due to few resources, while medium-sized enterprises, being larger, adopt more structured, diversified budget, maybe capital budget, operating budget, financial budget, cost budget, performance, and another. With departmental coordination. What is mandatory? What is mandatory for both? For both is mandatory is also, I think, about cash flow. In two types of businesses, we only use about cash flow, our revenues, and also we need to our cash flows. Also, this is mandatory. Oh, thank you, Rita, for your question. I just answered to your questions. Okay. How to develop a flexible budget for planning and performance reporting can be achieved in the short term is a special strategy. Yes, to prepare a flexible budget reporting sets by identifying variable costs per unit and fixed cost per unit. Adjust the budget amounts based on the actual activity levels, and then finally compare these adjusted budgets and then figures to actual figures to analyze variance. Maybe we okay, just I show you once more. Oh, this one. This one is about your question. How to develop flexible budget for planning, performance reporting. This actual budget, actual costs, and then so use it. This example, actual costs and budgeted costs, and then bit difference between them. This is short term. Okay, guys, thank you for your questions. I hope we will meet next lessons maybe. There are today is our lessons over. Thank you for attention, and then see you next time. Goodbye.
Bye.
Thank you,
Thank
Prof.
you.
Thank you, sir.
Thank you, Prof.
Ya Allah.